Hey there, Dave Keller with Market Misbehavior. The S&P 500 this week blowing past 4,200, now testing the 4,300 level. One of the big issues has been a lack of performance from offense over defense. That has now started to change. So 2023 has been a strong year for a relatively small number of stocks in three sectors, and really two: technology and communication services, maybe consumer discretionary, a distant third. After that, all the other S&P sectors are down year to date, even though the major averages have been strong. This is what's caused the breadth indicators that we follow, like advanced decline lines, the McClellan oscillator, percent of stocks above moving averages, bullish percent indexes, have all remained relatively muted, relatively weak, while the major averages have been moving higher. One of the really interesting characteristics of 2023 has been the relative performance of offensive areas of the market versus defensive areas of the market, particularly the performance of defensive areas. Utilities and real estate are often thought of as some of the more defensive areas. Low volatility, tend to be higher yielding or higher income, higher dividend paying names. And you really only want to own those sorts of sectors when you're trying to protect yourself against market instability. Consumer staples, that was arguably one of the most impressive measures of defense, particularly in the United States. In other countries, consumer staples can be a little more growthy, but in the U.S., it's a little more stable, sort of lower risk, more defensive stocks tend to pay a higher dividend and tend to be a little more ideal when the market conditions are bad. Now, why is that? I often think of the ratio of offense versus defense, consumer discretionary versus consumer staples, as really thinking about how investors are rotating between different parts of the consumer space. Things you want would be things like consumer discretionary, right? Things you only really need when things are good, right? Buying a new car, buying a new house, taking a trip, going to a hotel, taking a long flight. All of those types of stocks, buying a luxury good like a new watch or new clothes, these are all in consumer discretionary. They're really things you want. You don't necessarily need them. You do need clothes, but you don't necessarily need to upgrade your clothing. You could probably get by keeping some of the stuff that probably still works just fine. So these are discretionary purchases, things we don't really need necessarily, but that we want. They're things that make our lives richer and more interesting, arguably. Consumer staples are things you kind of need no matter what's going on, regardless of what your income is, regardless of what the economic conditions are, regardless of what your personal situation is. You still need things like household goods, cleaning products, toilet paper, beverages, alcohol, tobacco. These are things that are thought of as more staples, more things you need. Regardless of what's happening, you're still probably going to need those products. So by looking at the ratio of what things you want versus things you need, you can learn a lot about how investors are making their bets or what sort of behavior we're observing from consumers themselves. This chart is showing the ratio of offense over defense by looking at two ETFs, the XLY and the XLP. So again, it's the ratio of things you want over things you need. When this ratio is going higher, that means that discretionary is outperforming staples. Meaning that more offense over defense. When the ratio is going lower, that means staples are outperforming consumer discretionary, or another way to say it would be consumer discretionary is underperforming consumer staples, and investors are leaning more into companies that make products that are things you need instead of things you want. Now, I have two ratios here because I'm doing the cap-weighted version in the top half, the XLY and the XLP, but there are also equal-weighted versions of these ETFs in the bottom, the RCD for consumer discretionary and the RHS for consumer staples. Now, you can see that the ratios in general move together, and you can see that they've topped out usually in similar places, and they bottomed out in similar cases, but not always. And you can see sometimes where the cap-weighted version will make a new high and the equal-weighted version or not. You can see that the cap-weighted version actually made a new low in December of last year, while the equal-weighted version actually bottomed out in June of last year. Right now, the XLY versus XLP, the cap-weighted ratio has made a new high for 2023, while the equal-weighted version has not quite done so. Now, why is that the case where these ratios are different? It comes back to the weighting in our ETFs and in a lot of popular indexes. The cap-weighted indexes are really dominated by the mega cap stocks. So in the XLY, consumer discretionary, you have three stocks that make up about half of that ETF: Amazon, Home Depot, and Tesla. If those three stocks are doing well, that the XLY is probably going to be doing pretty well, fueled by those three names, or two out of those three names for sure. The equal-weighted version treats Tesla and Home Depot and Amazon like any other consumer discretionary stock, so they're equally weighted. Each one has one vote, and so overall, it's more of a measure of the average performance of the average stock, I guess is the way to think about it, within those two ETFs. What you found is through the end of April, both of these ratios were going lower. So while the S&P and the NASDAQ were rotating higher, testing that 4,200 level, you can see both of these ratios were actually remaining fairly low. Even through mid-May, the ratios were remaining at best sideways, and at worst sort of coming off of the new low. But look at what happened in the month of May and by the beginning of June. You can see that the ratio has pivoted aggressively away from consumer staples and into consumer discretionary. Now, what sort of stocks have created this sort of issue? I would say two things, right? Part of it are charts like Amazon that have done very, very well. When you think about the performance in the XLY, stocks like Amazon being strong, certainly providing a strong boost to the XLY because it dominates that ETF. It's the biggest weighting, and when that's doing well, the XLY most likely doing pretty well also. Amazon has been outperforming the S&P 500. As a result, this biggest name within the XLY, the biggest weight, has certainly been helping to push that ratio higher, particularly in the last 4 to 5 weeks, starting at the beginning of May of 2023. On the other hand, you have charts like Coke and Pepsi and PG, Procter & Gamble, and other big consumer staple stocks, also other ones, food products names like Archer Daniels, ADM, and others that have rotated lower. Coke is a classic one, testing resistance and rotating lower. So in the month of May, Amazon rotating higher, Coke rotating lower, and a lot of those sorts of things have happened to cause the ratio to go up. At the end of the day, though, this is indicating that offense is winning over defense. Starting in May, investors have rotated more bets to the offensive side of this ratio, and this is a classic indication confirming a bullish configuration or a bullish sentiment from investors. Now, I switched the top half of the chart to show the S&P 500 on a closing basis over the last 2 years, and at the bottom, I'm keeping that equal weighted version, the RCD versus the RHS. Look at how closely these lines match one another. You can see in the second half of 2021, the S&P is going higher and offense soundly outperforming defense. One of the great signals that the top was happening in 2021 at the end was the S&P making a new high, while a lot of other things were making a lower high. Small caps actually made a lower high. A lot of the other ETFs made a lower high as well. Breadth conditions like the advanced decline lines made a lower high, and this ratio of offense over defense made a lower high as well. It was one of the many things suggesting to us that that new high going into the beginning of 2022 was suspect, and that underneath the hood, the conditions were not quite as strong. You can see in the first half of 2022 how the ratio is going lower, the S&P, of course, going lower. As we made a new low in October, you can see this ratio did not make a new low. You can see that we actually found a relatively stable position for this ratio, suggesting more of a bottoming pattern. Now, fast forward to where we're at today. The S&P, of course, powering above 4,200. The XLY breaking to a new swing high versus the XLP with that cap-weighted ratio, and the equal-weighted version turning higher as well. Now, why do we focus on this ratio? Because it's a great illustration of the relative performance of offense over defense. Again, things you want over things you need. The fact that the market has rallied through much of 2023 without these ratios doing particularly well at the end of the first quarter was a big question mark, I would argue, for the bullish case for the S&P and the NASDAQ. The fact that these ratios have now rotated higher, showing that investors are rotating more to offense over defense, one of the many indications suggesting this bull market may have further to go beyond 4,200, maybe even beyond 4,300 and more. Now that this ratio of offense over defense is turning higher, what are your implications for the S&P 500? Thumbs up or thumbs down, bullish or bearish at this point, and why? Give me a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you again soon.